Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Balance of Power podcast. Catch us live weekdays at noon and 5 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
This is a difficult period of time for financial markets and a perfect time for us to be speaking with President Trump's economic advisor in the Council of Economic Advisors, where he works as chairman. Stephen Miran joins from the North Lawn of the White House on Jobs Day, as a matter of fact. Mr. Chairman, welcome back to Bloomberg TV and radio. It's great to see you. As we mentioned earlier, this jobs report would be our lead story on any other day, with payrolls blowing the doors off. But after everything we have seen in the financial markets, and knowing that President Trump has now put forth his plans for tariffs taking effect tomorrow and next week, are these data already old?
No, I don't think the data are already old. I mean, look, we're very pleased with the jobs report that we got. The economy created 228,000 jobs in March. That's roughly twice the amount of jobs that it created in either January or February. In fact, it was such a good month that it was, in fact, the fourth best month in the last 2 years for job creation. That's pretty spectacular. And, in spite of some headwinds that folks thought would be material headwinds, the president has acted very swiftly and forcefully to close the border and to prevent the surge of, and to stem the surge of illegal aliens coming into this country. And lots of folks said, oh, that'll be bad for job growth, right? That'll be bad for job creation. Well, this report proves that might not necessarily be the case. And so what the report shows is the economy is continuing to grow in spite of the president's variety of policies, and it's a good sign.
Mm-hmm. Well, but this report, Mr. Chairman, is by nature backward-looking. I think the concern financial markets have today is about the forward-looking picture and what the economy is actually going to look like in light of these severe tariffs that are being implemented starting tomorrow, the layoffs of federal workers that the Department of Government Efficiency is pursuing. How can you guarantee the labor market will hold up in the face of those challenges?
Yeah, thanks. So look, the president acted with historic scope and speed to address what was a decades-long festering problem that had been eroding our competitiveness and eroding our prosperity and eroding our economy. And so, of course, there's going to be some market volatility on the back of that. Of course, there's going to be some adjustments on the back of that. But on the end of it, things are going to be materially better. And I'll tell you why. Not only will the tariffs incent reindustrialization in America and companies coming back to build in America, but there's also two other legs to the stool that are of significant importance. There's the deregulatory agenda, and then there's the tax agenda. And both of those are profoundly stimulative for the economy. And one point that I like to make is that imports are only 14% of the economy. The other 86% of the economy is affected by the entirety of the agenda. And so that's tax and regulation, and both of those are going to be very important.
I'd like to ask you, Stephen, about the comments that we heard from Jay Powell a bit earlier today. The Fed chair had this to say about the potential impact of President Trump's tariff regime. Listen.
While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain.
Stephen, our Edward Harrison writes that unless the labor market data deteriorate precipitously, the bond market is going to have to reverse some of its post-Liberation Day rally, taking stocks down further in the process. The jobs report today is bad news for stocks and bonds, he says, because we're not going to see lower interest rates anytime soon. And the chairman today suggesting that he is in no hurry, even as President Trump puts on Truth Social that this would be the perfect time to cut interest rates. What is your message to investors when it comes to rates here against the backdrop of tariffs?
Sure. So first, let me be clear that, I'm not going to tell the Fed what to do, but I will point out that we lived an experience of tariffs in 2018, 2019 during the president's first term, and there was zero macroeconomic evidence whatsoever that tariffs had any material inflationary impact. In fact, the Fed wound up cutting rates on that event. So I think it's important to understand.
But we're talking a different scope and scale now, Mr. Chairman. The tariffs from the last administration are nothing like what we're seeing now.
Yeah, the president has acted with historic scope and speed. I agree with that. But we also have to appreciate what's going to be happening on the tax and regulatory front. And I think that one of the most powerful things for determining the supply side of the economy is the regulatory environment. If prices are high and increasing because there's not enough stuff, the best way to address that is to make more stuff. That means getting government out of the way, letting firms invest, letting firms build, letting firms produce. And if you make more stuff, you can address not only inflationary pressures, but actually bring some prices down. And I think that that's powerful and arguably much more powerful than any effects of tariffs.
But what is the actual lag time between seeing a lesser regulatory burden, seeing tariffs that maybe would incentivize U.S. manufacturing to invest in that capacity, the lag time between the decision to do that and the actual capacity coming online and whatever employment or what have you will come with it? This isn't going to be an automatic thing, right, Mr. Chairman?
Yeah, thanks. So that's a great point, which is that, the regulatory process and taking away those regulations is a legal process, and that takes some time. And the president has made historic progress in the first 2 months peeling back regulations, but there's still so much work to do. And it'll take some time for us to get that through. And so that's, maybe this is part of why there's market volatility, because implementing the totality of our plans will take some time. Congress is working on the tax package as we speak. It will take some time to pass it. It will take some time to implement it.
We're hearing a lot of concerns about a recession. Money managers are pointing their trades toward a recessionary environment, and JP Morgan today increased odds for its recession forecast to 60%, up from 40%. Stephen, what are yours?
Yeah, I'm not a professional forecaster, so I don't necessarily have odds. But what I will say is what I said a moment ago, which is that imports are only 14% of the economy. So you really have to think of, really, really huge, really enormous changes sort of shaking through those things to get to the place where you think a recession is likely as a result of something like this. And as I said before, I think that the president's pro-growth policies on the regulatory front, providing further tax relief to American families, extending the tax relief of his 2017 Tax Cuts and Jobs Act, I think all of that is profoundly supportive of growth. And I think there's maybe a little bit too much focus on risks from what's going on right now, and not enough focus on the pro-growth policies that are
well, we're certainly focused on Wall Street. I understood. I don't mean to interrupt, sir, but there's a great worry about the negative wealth effect. This market is in free fall right now. We could continue this next week unless there is some change here in the news cycle as we hear about additional retaliatory tariffs. At what point does this drag consumer spending with it?
Yeah, so look, you're right. There can be some wealth effects. There will be some wealth effects. There will be, there will be ramifications of that stuff. But like I said before, we have to balance that out against the totality of other stuff going on in the policy agenda, the totality of the other strong drivers of economic growth. One point that I've made a lot is that the Biden administration's last 2 years, almost 3/4 of jobs that were created were in government and government-adjacent sectors, and that's profoundly unsustainable to have the government gravy train driving the economy. In the March jobs report, that number came down from almost 75 in the last 2 years of the Biden administration to just about 40, right? So that's a very material decline, and this is part of reconfiguring the economy from a government-driven growth engine to a sustainable, durable private sector growth engine, and this is going to continue.
As we consider the growth outlook, keeping in mind that you did just tell us, Mr. Chairman, that some of this will take time to materialize in terms of the stimulative efforts of this administration, whether legislatively or otherwise, if the Federal Reserve were to decide that it has to prioritize inflation, and if inflation persists and they don't want to cut rates, but we do see a material downward shift in growth or in the labor market, is there a lever that the White House is going to be able to pull more immediately to try to offset those effects if the Fed can't do both at the same time?
Yeah. So again, I'd point you to the forthcoming tax legislation that's being worked out on the Hill, and I think that will allow the president to provide profound tax relief that will be excellent for American families, American workers, American firms.
Well, going forward, Mr. Chairman, I wonder what's going to happen in terms of messaging to this market. Are we going to hear more from the administration, from the President of the United States, from yourself, when it comes to the dollar, when it comes to investing in the stock market in the United States? I know that frequently the refrain is we're seeing companies invest in America, but how about in our financial markets where we've seen, I believe, a half dozen IPOs today delayed, some of them pretty large. We're hearing from some major firms planning to go public as soon as next week. that are putting those plans on the shelf? What does the administration tell them?
Yeah, so I'm not gonna comment on specific companies and IPOs, but I will say what I said before, which is that of course there's going to be some market volatility on the back of the president's historic actions. But I also want to redirect you again to what we can do. And so, the tariffs are designed to redress the emergency of trade deficits, but there is a nice side effect, which is they raise a lot of revenue. And if you use that revenue not only to extend the historic tax cuts from 2017, but to provide further tax relief for American families while deregulating the economy and making it easier to invest, build, hire in America, you have the recipe to create an economic boom, wherein America is much more competitive because of the tariffs. It's much more competitive because lower taxes, households, firms, workers keep more of the money they earn every week, and they spend more of it, they save more of it, they invest more of it, and you get the government out of the way so they can build and invest and make factories. And that is the recipe for an economic boom. And if we keep at it, we can create a really great environment for firms to invest and hire, and that will, in the long run, drive the financial markets.
The other thing that tariffs, you would think, at least traditional economic theory would tell you, would lead to is a stronger dollar, and yet that's not what we've seen in the immediate aftermath of the announcement of these, Mr. Chairman. How concerned are you about a period of sustained dollar weakness?
Thanks. So, look, my view, as I've expressed before, is that classic economic analysis would say that the burden of any economic policy, whether it's a tax, a subsidy, no matter what it is, falls on what economists would call the more inelastic party, but I think is easier for other folks to understand as the more inflexible party. And the example that I keep giving is if you're looking to buy a house and the town that you're looking in raises its property tax rates and you're flexible, you can just look at the next town over. You can change your behavior to avoid the burden of the tax. The person who's selling the tax can't move his house across town lines, so he's got to eat the property tax and lower his selling price. And in that way, the burden of the tax fell on the person who couldn't move his house. And the same is going to be true in international trade. American consumers are flexible. We can make stuff here at home. We can change the countries from which we import. We can stop importing from a country with a high tariff rate and start importing from a country with a low tariff rate that treats us better, that is a better trading partner with us. And that ability to change our consumption patterns, whether to move it home into home production or among different countries, makes us more flexible. By contrast, installed factories in China, they've already spent the capital, the factories are stuck on the ground, the workforce is already trained to build products aimed squarely at the U.S. consumer markets, those cannot move. So in the long run, other countries, the tariff countries, will end up bearing the burden of the tax, of the tariff. Now, there's a couple ways that can happen. In 2018, 2019, it happened through the currency, but it need not happen that way again. It could happen that way. It doesn't necessarily have to happen that way. There are plenty of other ways they can end up bearing the burden of the tax. It could happen through reduced selling prices.
All right, Mr. Chairman, we appreciate you joining us here on Bloomberg TV and radio. Stephen Miran, the chair of the Council of Economic Advisors at the White House, thank you so much for joining us on this Jobs Day. But of course, while we did get a strong payrolls report, we are not seeing strength, at least in risk assets today. We're right around the session lows on the major equity benchmarks. The S&P now down 5.2%, the NASDAQ 100 down 5.4%. We want to get more on these markets now with Bloomberg's Romaine Bostick, who is joining us from New York. Romaine, I got to say, I'm kind of feeling flashbacks to March 2020 here.
Yeah, not just around session lows. We are at session lows. And just to put this into perspective, Kailey, 500 stocks roughly in the S&P 500. Only 14 of those stocks right now are in the green. We're headed towards what is going to be more or less an unprecedented day. The superlatives pretty much stack up like this. More or less, we're having the worst day since at least 2022. For certain sectors, the worst day since the onset of the pandemic. And if you take the pandemic out of the equation as sort of a one-off outlier, this is quite frankly shaping up to be one of the worst days since the late 1970s. This is a market that is completely shut down, not just in equities, Kailey. We've had several IPOs that have been put on pause. That includes names like Klarna, StubHub, Chime. Several deals that were in the works have also been paused. Not a single corporation has been brave enough to try to sell new debt today or yesterday. And right now, you have this sense of paralysis amongst economists, despite the comments that we just heard from the CEA chair just a few minutes ago. Most economists say right now they have no idea how to chart a path forward.
You know, you talk about the fundamentals in this market, Romaine, kind of falling apart. What about the technicals? We have so many broken charts. Even if the news improved, would that help to lift stocks from where they are now?
Well, keep in mind, a couple days ago, Joe, the support line on the S&P 500 was supposed to be 5,500. Then when we got broke below that, people said 5,400. Right now we're trading right around the 5,100 level. That is the low of the day, 5,104 and change. And so whatever support levels were there, they've been broken. Even when you look at other sort of lines, such as moving averages, Joe, the fact that the S&P 500 right now is in oversold condition, that's where that 14-day RSI dips below 30. Traditionally, these are all lines in the sand where typically you'll start to see a rebound in stocks. The dip buyers come in. You're just not seeing it there right now. The technicals are working against them. The fundamentals, potentially, because of economic conditions, are working against them. So the big question right now, Joe, is if you do want to stay in this market, what actually do you buy? What are you brave enough to buy?
Not the truth. The analysts aren't exactly telling us. Romaine, it's great to see you. It's been great having Romaine Bostic with us.
I have a feeling we're going to talk again
these
soon,
very bumpy
Joe.
days this week. I think that might happen. What are you doing at 5? With me in Washington, Kailey, Leinz, of course, here on the fastest show in politics, as we try to bridge here what's happening in Washington with what is happening on Wall Street. You can't remove the two here, Kailey, as we reach ever lower, having heard from not only the president, but the Fed chair.
Yeah, the Fed chair signaling they're still not in a rush to cut rates, though he is warning of the inflationary risks of these tariffs. And it's interesting to note, after we heard from the chairman, you saw even more buying coming into the bond market. Maybe that's the only thing anyone wants to buy. The 10-year yield right now down 11 basis points at 392. This is Bloomberg.
You're listening to the Bloomberg Balance of Power podcast. Catch us live weekdays at noon and 5 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The worst two-day stretch since March of 2020 is what we're heading for right now, with a bid coming into the bond market as investors are looking for safety somewhere, keeping in mind they all just heard from the chairman of the Fed. While there may be some persistent inflationary risk due to the tariff policies announced by President Trump this week, the Fed is still not in any rush to lower interest rates, despite perhaps, Joe, the desire of President Trump for them to do so. He actually said on True Social today it would be the perfect time for Chairman
Today would have
Powell
been right before that meeting, maybe. In fact, that was timed to coincide with his remarks. It wasn't until Jay Powell started talking that we saw these new lows on Wall Street, because now the fear is, of course, we're not going to see lower interest rates anytime soon. Fascinating conversation with Stephen Miran at the White House coming off the jobs data today. He continued to point us to Trump tax cuts. They're just getting the ball rolling on that on Capitol Hill. In fact, we're going to have some votoramas over the weekend that could be pretty interesting. We'll be talking about that likely on Monday. But what a treat to have the chairman of the House Financial Services Committee with us. We remember when he was just a congressman. We remember when he was just a community banker. But that's why this is an important conversation, because of the unique perspective that French Hill brings to us from Arkansas. It's great to see you. It's been too long. Thanks for coming in.
It's been great to be back with both of you. Thank you.
So what do you think of this? I know you're sensitive to the markets. You don't like what you're seeing here on Wall Street, I'm sure. The line from Stephen Miran was, just hang on. We're working on extending the Trump tax cuts along with a number of other tax points of tax relief that will help to make this better. Does one offset the other?
Well, I think it's such an important question, and I'm concerned that we cover up the strategy of right-sizing regulation, tailoring regulations, getting balance back in the regulatory system, which President Trump was so successful on in his first term. We want to do that in this term. And as you noted, the Senate will be voting on the House Budget Reconciliation Bill this weekend that'll lead and unlock the ability to block a major tax increase for business and for American households. Those are big, certain issues that I think we can get done. I believe strongly in them. And I don't want to see a tariff strategy, offset that, which is why I believe in trade diplomacy. I think President Trump's right to engage in trade diplomacy, but I believe sincerely that you should target sectors in a very isolated way and achieve results, and do the same thing in reciprocity with countries you think are bad actors that are not open to American products. And then finally, as it relates to Canada and Mexico, I really think the president should advance the negotiations on the USMCA reauthorization of that treaty, that trade arrangement, and let's make some changes. Let's make sure that Chinese component parts are not dumped into Mexico or Canada and go into the supply chain.
So why not have Congress take the lead on that? It is your Article 1 authority to do so, and yet this is being driven out of the White House, not by your chamber or by the Senate. Does that need to change to calibrate this policy in a better way for the economy?
Another good question. Since the late 1920s, Congress had been in the tariff setting business, and they were so frustrated by it and so bad at it that they delegated it to the executive branch under trade promotion authority. But I think Article 1's job there is to make sure we try to get it right, work with the administration to get it right in the Senate's case, ratifying treaties where necessary. So that's what we need to do. Trade promotion authority, which was reauthorized in President Trump's first term, has expired. President Biden did nothing about it. I think that would be a good step for the Congress to consider reauthorizing that. What does the banker inside you, never mind the chairman of financial services, think about when you hear companies say, why are we being unfairly targeted? All we have done is play by the rules. We came out of China, we went to Mexico, we went to Vietnam, now we're being penalized for that. Aren't they correct in making that point? Well, I think it speaks to the uncertainty nature of this. I hear it from my own constituents at home who are manufacturers who make something, but some of the component parts and what they make comes from outside the U.S. They're concerned about the cost. Will their product be competitive? And the same is true for Arkansas, a big agricultural state. Right. Much of what we produce goes to Canada or Mexico. So these are important issues, and that's why I think the strategy has to be right. Using trade diplomacy to open new markets, using trade diplomacy to lower rates in certain product categories, like auto in the European Union, for example, and using trade diplomacy to punish bad actors. Those are all important elements of it, and I think that gives some certainty. When you use an across-the-board approach, you get that uncertainty that my constituents are reflecting. So I hope we can work on clarifying that in the weeks ahead.
Well, and in the weeks and months ahead, the White House, as Joe mentioned earlier and you were alluding to, the White House is pushing toward tax cuts that have to happen at some point if the TCJA is not going to expire. I do wonder, though, the argument around that tax package in 2017 was it was going to juice the economy. It was going to put more money into people's wallets. It was going to give businesses more money to make capital investments. Is it going to have the same effect this time around, though, if it's just an extension of what already exists and those people and businesses may be feeling a bit more of a pinch in terms of the margin they actually have to work with to spend that additional capital?
Well, the expensing has been being phased out, and so the renewal of that, I think, will spur a capital investment. The R&D tax credit, the same. It will spur new investment. You're right, at the corporate marginal rate or at the household marginal rate, people would just feel relief. Good. I mean, I can count on that going forward. So I think it will unlock some activity in the economy, and it will produce faster economic growth, even if the marginal rates don't change dramatically. There was a time when revenue from tariffs was pitched as a way to help pay for extending or making permanent the Trump tax cuts. Is that part of the conversation any longer, or are the tax cuts going to be extended in lieu of the tariffs? Well, in our discussions in the House, I can't speak for the government at large, but in our discussions with our colleagues in the House, we've been thinking about the importance of extending the President Trump's tax cuts, cutting spending, trying to right-size government so that we don't have $2 trillion deficits. This is a major goal of our House Budget Committee. And we're not counting on tariff revenue because tariff revenue is very difficult to predict. You have countervailing duties. You have people will change their buying patterns. So to automatically assume that you can count on that, I think is not significant or smart. So we have not per se counted on that. And OMB does not count tariff revenue in their scoring. So as we get closer to that final vote, we'll look and see where this Trump tariff plan settles, and that may give us some indication. But in the meantime, we're working independent of that, I'd say.
We were just listening from our colleague Charlie Pellet looking at the markets, specifically at bank stocks, some of the big investment banks that were counting on a revival in companies coming to the public markets and re-engaging in M&A activity. This gets back to the kind of regulatory burden you were referring to earlier. Are you concerned that some of this wider economic impact, companies now deciding perhaps is not the best time to enter the public markets, that regulatory burden being eased maybe for not if they can't actually take advantage of it?
Right. Well, certainly, I hope that the competition focus of a Trump FTC, Federal Trade Commission, is open towards business entrepreneurship, business combination, where it produces more competition. And I would hope that we are able, in our regulatory focus on capital formation, to encourage more public companies because we lower the cost quarterly of being public. That's a goal of mine as chairman of the committee. But anytime you have wide market uncertainty in equity prices, you're going to have people pull back from a scheduled IPO because they need market certainty. Right. And so I hope this settles down soon because I know there's a lot of interest in advancing that equity market through the IPOs.
We've been talking, Mr. Chairman, for the better part of 10 minutes, and somehow Kailey Leinz has not asked you about crypto.
I was saving it for last.
About the Stable Act. Well, my gosh, we only have a couple of minutes left here. Yeah. You had an important week when it comes to this. It's something that gets lost in a very noisy news cycle, but this is important, something you've been pursuing for months and months.
This is a real effort for the past 4 years, really, working with former Chairman Patrick McHenry, Ranking Member Maxine Waters, to craft a dollar-backed stable coin under U.S. law inside the largest capital market, the most important economic country in the world, that we would have our own dollar-backed stable coin where we could have a tokenized dollar payment on a blockchain. We had a successful markup, bipartisan result, and this is a companion to just a few weeks ago. Bill Hagerty, Cynthia Lummis, Tim Scott, Diane Gillibrand got a Senate dollar-backed stablecoin bill out of the Senate Banking Committee. This is the first time we're demonstrating, I think, to the markets that we can make progress on this. I think we can get that passed this year, and I think we can also get the market structure bill passed. You've got to link them because a dollar-backed stablecoin, but without market structure, how would you custody it? How would you exchange it? How would it be used? So they're important that we try to keep them working together. President Trump's asked us to complete that work by the August recess.
Okay, so in terms of sequencing, will we see a full floor vote on the stablecoin legislation before market structure efforts begin, or is that already underway?
I think House and Senate leadership have the best strategy under discussion. Tim Scott, Bill Hagerty, Cynthia Lummis, they're outstanding leaders. They know this issue well, and we know it well in the House, so we're going to craft the best legislative strategy.
All right. How different will it be to Fit 21?
We have our first hearing next week. Brian Stile of Wisconsin will convene his first market structure hearing in the House. We're excited about that, and we hope to get that text ready in the next few weeks.
We need a Stile Hill panel.
Yes.
Oh, yes.
When the time comes. Can we do that?
We can do it.
All right.
All right. Well, we'll look forward to it. And we
Great
were so excited to have you in studio today, Mr. Chairman. That is the chair of the House Financial Services Committee, Congressman French Hill of Arkansas, here with us on Bloomberg TV and radio. Interestingly, crypto won bright spot today, I would note, right? Joe. If you're looking for haven, maybe you're finding it in treasuries, but maybe a little bit of marginal buying coming into Bitcoin as well. Can't say the same for other risk assets, though, as we're just off session lows, but still down about 5 percentage points on the S&P 500 and NASDAQ 100.
A little bit of a bid under Bitcoin, but this is a risk-off market. My goodness, we're still trading near the lows of the session, and we'll have a lot more coming up here on the fastest show in politics. You can't remove Washington from Wall Street. That's why we're here on Bloomberg TV and radio alongside Kailey Leinz. I'm Joe Mathieu. Thanks again to Chairman French Hill. We'll have much more ahead on Bloomberg.
You're listening to the Bloomberg Balance of Power podcast. Catch us live weekdays at noon and 5 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
So a new date to circle on the calendar, Kailey, 75 days. Not a big shock. Obviously, we were creeping up on a deadline in the next 24 hours without a deal in place. It's unclear, though, whether still, I ask, would China sign off on such a deal? Because that would be required for this to happen, and they just put retaliatory tariffs on us today.
Yeah, well, and the president does make reference to that in his post on True Social. He says, we hope to continue working in good faith with China, who I understand are not very happy about our reciprocal tariffs. He goes on to say, this proves that tariffs are the most powerful economic tool and very important to our national security. Keeping in mind, the president has floated multiple times over the last week, lessening the tariff burden on China if it means they agree to a TikTok divestiture.
Tariffs the most powerful economic tool, though, I guess, in generating reciprocal tariffs and in sending the stock market lower, because that is what they have achieved today. Commentary from Jay Powell seemed to only make it worse. Yeah,
well, and we want to get some more commentary of our own here on this program as we bridge Wall Street and Washington and turn to Democratic Congressman Glenn Ivey of Maryland, who is here with us in our Washington, D.C. studio. We have much we want to discuss with you, sir, and welcome back to Bloomberg TV and radio. First, though, as I know you did vote for the legislation that included this divest or ban law for TikTok, another 75-day extension. Does this go against the nature of what that law was actually supposed to achieve?
Yeah, it does. And if you look at what they did over the previous extension that the president gave them, as far as seeking a business solution, I didn't see really any effort to do that. So extending them 75 more days to do what is the question that I have. If they're not really going to be trying to figure out a way to resolve this from a business perspective, then they're just playing a stall game and the president's falling for it. So I hope he'll get out of the way of that. I don't think he really has the statutory authority to do what he's doing here, but we'll see how it plays out.
Well, in the time that you were preparing to vote on that bill, the bipartisan case was established that this was a national security threat. Has any of that changed?
I don't think so. And if you look at the ads that they run, which never mention ByteDance, but float all these nice people in Middle America who are making money using TikTok, and we all know that that's the case. But the fact that they're continuing to push it and act like this is only about TikTok and has nothing to do with ByteDance, I think indicates how the potential for misinformation and disinformation can be spread through this, and they're doing that very aggressively and apparently pretty well.
Well, so there's the national security element of TikTok. I guess there's also the national security element of something that the president is now tying to TikTok, which is his tariff policy, maybe using it as leverage in this particular instance. But overall, as we consider the tariff regime that was announced by the administration this week, I'm wondering what you're hearing behind the scenes from your colleagues in the House, not just from your fellow Democrats who are obviously making their feelings well known, but from Republicans. Are they saying things to you in private that they're not willing to in public about this?
Yeah, but I mean, you're starting to actually see them say things in public too.
Sure.
I mean, the loud screams you hear in the background are not just Democrats and average Americans. They're Republicans who see this as maybe one of the biggest political blunders that I can recall in recent memory. This is a total unforced error. The economy was moving in a relatively good direction. Whether you like what Biden did or not, when he left, the U.S. economy was pretty much the envy of the Western world. Trump inherited a good economy. The jobs report that just came out indicates that things were moving in the right direction, probably. All he had to do is kind of not get in the way, and this is driving the truck off the cliff. I've never imagined that he would do this. And then to do across-the-board tariffs on every product for almost every country at the same time, and then act like you're going to negotiate with all of these at the same. It's ridiculous. I'm not sure what he was thinking when he did this, but I don't know what the exit ramp is. I don't really see one. He's mad at Powell for not giving him one, but Powell did, I think, what people were expecting the Fed to do under these circumstances.
Well, the impact locally for you is very real. It's not just the tariffs here, and that's obviously hitting people across the board. The market reaction hits people across the board. The DOGE cuts, though, hit you directly, with federal workers who live in your district who are being shown the door. Then you add what took place with some of the budget cutting. I know that the House has yet to reverse the budget cuts for the District of Columbia, but people are starting to sit back around here. We're on global television and radio right now. People are listening to you as well on 99.1 FM in Washington saying, hey, wait a minute. The Washington, D.C. area, the DMV, used to be recession-proof because of the fact that the federal government was here, or at least there was a shock absorber, Congressman. Does that exist anymore?
Maybe not. What he's done in the attack on federal employees is been extremely damaging. I mean, he's thrown people's lives up in the air. And I know there's a lot of people who don't have sympathy for so-called bureaucrats, but people are now starting to feel the impact of the services that they're not getting because these people have been fired. And some of these things are going to be very long-reaching and far-reaching. So, cutting the clinical trials for Alzheimer's, cancer, Parkinson's, My father died from Alzheimer's and Parkinson's, a combination of those. So to see the clinical trials derailed just kind of, by happenstance is astonishing. Wow. And then the impact on people who are seeking their PhDs or starting their research careers. Mm-hmm. We're going to have IonQ on here in a minute, but China's throwing money at AI, quantum computing, and the like. They're trying to grow as many of these scientists and engineers as possible. Trump's cutting the money for that, and that's just scratching the surface. Mm-hmm. I mean, we could go through the impact Medicaid cuts, sure, impact on elementary schools, the impact on local hospitals in rural and urban areas. I mean, it's astonishing, it's far-reaching, it's extremely damaging. And I think when you combine that with the tariffs that he's put in place now, mm-hmm, you're certainly looking at a recession in the Washington metropolitan area, but I think you're probably looking at one nationally as well.
You mentioned IonQ. This is a quantum computing company that you introduced us to some months back, and you were joined on the air here by the then CEO. Niccolo de Masi, the president and CEO of IonQ, now in charge of the company, joins us now as part of our conversation. Niccolo, we want to add your voice to what we're talking about here and welcome you to the conversation with a lot of questions we have about quantum computing and the charge that you have at IonQ. Been pretty remarkable hearing you called out by Jensen Huang recently, but there are great concerns now about a company like yours seeing innovation stifled and having more difficulty accessing capital because of what's happening in the financial markets driven by the tariffs. What do you think?
Well, first of all, I want to thank the congressman for including me in this, and thank the congressman for all the support that he's given to IonQ. We were born on the University of Maryland campus 30 years ago with Dr. Chris Monroe, and we, of course, do a lot with the university, the ecosystem, with the DMV, and of course with all the associated ecosystem of agencies in the area. You mentioned China. I mean, absolutely, they are investing, probably $15 billion officially in quantum computing, and I bet it's more unofficially given how things work over there. And I would concur that quantum computing and quantum networking, which is the other half of our business, so it's safe making and safe breaking, really are not just paramount for the national security of our country, but they're fundamental to the economic growth prospects of our economy. And so, we work, of course, across the aisle. We work with the administration, every administration, and it has been a bipartisan issue, which we're grateful for. I mean, our machines are made in America. Our quantum networking also is rolling out in America in places like Tennessee, for example. And ultimately, we believe that, tariffs will be a far bigger issue for companies that are structured differently than IonQ. But nevertheless, we look forward to continued support in the state and, of course, federally as we continue to grow this vital technology for our country.
But what about the notion that, at least in terms of China's retaliation against the U.S. policy announced this week, it's not just tariff measures, but also restricting access to critical minerals? Is that something, given the role that those play in quantum computing, that could affect your company?
Well, it can affect some companies in the quantum computing space. Fortunately, it doesn't impact IonQ. Just yesterday, DARPA, in fact, awarded us the first stage of their own journey towards building, let's call it encryption cracking and encryption protection. So, the basis of modern civilization relies on secure communications. Battlefield of the future relies on Battlefield of today relies on secure communications. And ultimately, quantum computing helps you both optimize that, and quantum networking helps you ensure that e-commerce, banking, you name it, as we know it today, goes on, perpetually, right? So this is an issue that, we fortunately are well funded. Our stock, of course, has not had a great day today, but our stock has had a better day than everybody else who's exposed, fully to these measures for sure. We're heartened by the fact that we've got such strong support in Maryland and many other states, as well as in the federal government. They all recognize the criticality of information, the criticality of optimization, the criticality of computing. Jensen Huang will see us as a competitor someday, but at the moment, we're just expanding the compute market with quantum processing units. And our technology that you can see behind me is actually what's called an ion trap quantum computer. And we don't have to import any minerals for this, fortunately.
This is really impressive stuff, Congressman, which is why, of course, you introduced us to IonQ. Knowing that they're working at the University of Maryland, how concerned are you about federal grants being withdrawn or being challenged by this administration and testing the innovation of a company like this?
It's extremely problematic, and we've got other entities. Johns Hopkins is in Baltimore. They're outside of my district, but they just had to lay off 2,000 employees based on what the administration had done as far as cuts. And if we're looking at growing the field of scientists and engineers that are coming up out of college, out of graduate school, and getting into these professions now, he's wiping out the grants that they use to do their research. He's wiping out the indirect cost payments so that allow these universities to do it. He's wiping out the grants and, in some instances, contracts that go to federal agencies like NASA, where the research is done. So we've got this crop coming up with no place to go here in the United States. While, by contrast with China, they're not only are they, growing more of these people faster, but they're throwing dollars, or the Chinese equivalent of that, into funding it so they can expand it quickly. We're still in the lead, but the president's walking us off the field right now, and when we should be competing and maintaining the lead that we have.
Well, Nicola, we only have a minute left, but can the private sector make up for anything or the lack, I guess, of investment or a pullback in investment from the public sector?
We're doing our best, Congressman, for sure. We're trying to grow the job market, our quantum center that we have in partnership with, of course, Maryland and UMD, and we're very much part of, and I think a central tenet of the quantum initiative and expansion of our headquarters to create those research opportunities, create companies and incubation and entrepreneurship around our technology. So we're well capitalized, and we'll do all we can every day. Needless to say, though, we rely on partnerships with Maryland, the university, the federal government, to ensure that our technology makes it into the commercial sector, the public sector, onto the battlefield, into drug discovery, into let's just call it aerospace of the future and optimization opportunities of the future every day of the week. So let's hope that this is a moment in time, and that it's all up from here for both of us.
All right, Niccolo de Masi, President and CEO of IonQ, joined by Democratic Congressman Glenn Ivey of Maryland, here with us on Balance of Power today. Thank you both so much.
Thanks for listening to the Balance of Power podcast. Make sure to subscribe if you haven't already at Apple, Spotify, or wherever you get your podcasts. And you can find us live every weekday from Washington, D.C. at noontime Eastern at Bloomberg.com.